Lost wealth, shattered dreams, and global panic, market crashes have a way of rewriting history. But here's the thing, crashes don't come out of nowhere. They leave behind warning signs, patterns that repeat. So, are we heading toward another one? Let's dive in. First, let's look at the biggest crashes in history. In 1929, the stock market crash led to the Great Depression, wiping out millions of investors. The cause? Over-leveraged markets and blind speculation. Fast forward to 2000, and the dot-com bubble burst, erasing trillions in tech stock value when overhyped companies couldn't deliver on their promises. Then, there's 2008, the housing market collapse that sent shockwaves across the globe. Risky loans, greed, and overconfidence led to one of the worst recessions in modern history. What do these crashes have in common? Warning signs. Let's break them down. Warning sign 1: overvalued markets. When stock prices climb faster than company earnings, it's often a bubble waiting to pop. This happened during the dot-com boom. Warning sign 2: excessive debt. Leverage can fuel market growth, but too much leads to collapse. Remember the 2008 crisis. Mortgages people couldn't afford, bundled into risky investments, brought the entire system down. Warning sign 3: rising interest rates. When borrowing gets expensive, markets tend to slow down. Historically, this is often a precursor to downturns. And finally, warning sign 4: mass FOMO, fear of missing out. When everyone, from your neighbor to your cab driver, is jumping into the market, it's a sign of irrational exuberance. Now, what happens during a crash? First, panic selling. Fear spreads, and investors rush to sell, making the downturn worse. Then comes a liquidity crisis, cash dries up, and businesses start struggling. Recovery follows, but it can take years or even decades. So, how can you protect yourself? Here are 4 steps. 1. Diversify your portfolio. Spread your investments across stocks, bonds, and alternative assets like gold or crypto. 2. Keep cash on hand. Liquidity is your lifeline during a downturn. It lets you buy assets at a discount. 3. Stay disciplined. Panic selling locks in losses. Stick to your long-term strategy and avoid emotional decisions. And 4. Educate yourself. Learn from history, watch for market trends, and stay informed. Market crashes aren't just a thing of the past, they are a reality we'll face again. But by preparing, you can not only survive but thrive. Remember, history is a teacher. Don't ignore the lessons. If this was helpful, make sure to follow *Bold Horizons * for more financial clarity. Let's navigate the future together.